In Forex, nothing happens in isolation. When the US Federal Reserve cuts interest rates, the shockwaves don't just stay in America, they ripple across the globe. And for UK traders, those moves can reshape the Forex market overnight. If you don't understand these global spillovers, you're trading blind. Today, I'll break down how Fed cuts shake the US dollar, the British pound, and the Forex battlefield you step into every day. Point 20. Why the Fed matters globally. If you want to understand why the US Federal Reserve matters more than any other central bank in the world, you first need to understand the role of the US dollar in global finance. The dollar isn't just America's currency. It's the backbone of the global financial system. Over 80% of Forex transactions worldwide involve the dollar. Commodities like oil and gold are priced in dollars. Countries hold their foreign reserves primarily in dollars. Global trade, global loans, and global investments are deeply tied to the dollar. That's why when the Fed makes a move, the effects spill out across every corner of the world, including the UK Forex market. Now let's break this down. The Federal Reserve controls US monetary policy, primarily through interest rates. When they cut rates, they're lowering the cost of borrowing in dollars. That might seem like an internal American decision. Instantly changes how global investors view risk, where they put their money, and what currencies they favor. Because the dollar is so central, the Fed's actions often matter more to the global market than the moves of other central banks combined. For UK traders, this is critical. Too often, beginners focus only on the Bank of England, thinking that GBP movements are driven mostly by domestic policy. Yes, the Bank of England is important, but when the Fed cuts, sets off global portfolio shifts. Investors worldwide move trillions of dollars across borders, and that capital flow slams directly into GBP, USD, EUR, GBP, JPY pairs. Imagine you're an investor sitting in London, New York, or Hong Kong. If US interest rates suddenly drop, the returns on US assets like treasury bonds become less attractive. You don't want to park your money in something that yields less. So what do? You look for better returns elsewhere. Some of that money flows into the UK, into gilts, into UK equities, or simply into GBP as a currency play. That capital flow strengthens the pound, at least in the short term. But the flip side is also true. If the Bank of England is dovish at the same time, pound may not benefit much. Here's the bigger picture. The Fed doesn't just move the dollar, it moves global risk appetite. A Fed cut can signal two things. Either the Fed wants to stimulate growth, or the Fed is worried about a slowdown. If traders believe it's growth friendly, risk appetite rises, and money flows into riskier assets, including emerging market currencies and the pound. If they believe it's a sign of weakness, then fear spreads and traders flee into safe havens like the yen or gold. In both cases, GBP is caught in the crossfire. This is why every UK trader must watch the Fed. You can't afford to ignore it. You can't just say, I'm trading the pound, I only care about the Bank of England. Wrong. The Fed is the global referee. Its decisions dictate where money flows, how traders position themselves, and how volatile the market becomes. Think of it like this: Fed is the central nervous system of global finance. When it makes a move, every market muscle twitches. For UK traders, this means that your charts, your setups, your risk, all of it is tied, whether you like it or not, to Washington. So the next time the Fed cuts, don't treat it as American news. Treat it as global news. Treat it as the spark that will ripple through your GBP USD chart the next morning. Because that's exactly what it is, a domino effect that starts in the US and hits the UK market like a tidal wave. Patience, awareness, and preparation are the only shields you have. And that starts by understanding that in Forex, the Fed isn't just another player, it's the game changer. Point 28, Fed cuts and the dollar's weakness. When the Federal Reserve cuts interest rates, the immediate expectation in the market is simple: the US dollar weakens. Why does this happen? And why does it matter so much to UK Forex traders? Let's start with the mechanics. Interest rates determine how attractive a currency is to global investors. Higher rates mean higher returns on assets denominated in that currency. For example, if US Treasury bonds yield 5% and UK gilts yield 3%, investors will naturally prefer the dollar because it gives them a better return. When the Fed cuts rates, say from 5% to 4%, that yield advantage starts to shrink. suddenly holding dollars doesn't look as appealing. Investors begin to move money into other currencies, chasing higher yields. That flow of capital out of the US reduces demand for the dollar, pushing its value down. This is the textbook version, but in reality, Forex is never that simple. UK traders need to understand that while a Fed cut tends to weaken the dollar, the actual market reaction can be far more complex. Why? Because markets don't just react to the decision, they react to the expectations behind the decision. Very often, by the time the Fed announces a cut, the market has already priced it in. Traders and investors anticipate Fed moves weeks or even months in advance based on economic data, inflation reports, and speeches from Fed officials. That means when the cut actually happens, the dollar might not fall as expected. It might even strengthen if the cut was smaller than traders feared, or if the Fed hints that no further cuts are coming. This is where things get dangerous for impatient traders. Many beginners in the UK market assume Fed cut to short the dollar. But if you trade like that without considering market expectations, you're setting yourself up for a trap. The truth is, the reaction depends as much on the Fed's forward guidance as on the cut itself. If the Fed signals that it will continue cutting aggressively, the dollar usually takes a beating. But if the Fed hints that the cut is on and done, the dollar might hold steady or even rally. Now, let's look specifically at GBP USD. When the Fed cuts, pressure on the dollar usually gives the pound a boost. Pound strength isn't absolute, it's relative. If the Bank of England is also dovish, or if UK economic data looks weak, GBP USD may not rise as much as traders expect. In fact, you might get choppy moves where the pair spikes up on the cut, only to retrace when traders realize the pound isn't in much better shape than the dollar. This tug of war is where smart UK traders make their edge. They don't just react to the headline, they analyze the bigger picture. They ask, what is the Bank of England doing at the same time? What's the tone of the Fed? Is the cut priced in? What's global risk sentiment? Another layer here is the carry trade effect. When US rates are high, investors borrow in low yield currencies like the yen and park their money in higher yielding USD assets. When the Fed cuts, that carry trade unwinds, leading to massive capital flows out of the dollar. Those flows can create violent volatility, especially in the London session when liquidity peaks. GBP USD often becomes the battleground for this shift. Finally, we can't ignore psychology. A Fed cut can trigger fear in the market. Traders may interpret it as a sign that the US economy is in trouble. That fear can amplify dollar weakness as investors flee into other currencies or safe havens like gold. The market interprets the cut as supportive for growth. Risk appetite can rise, boosting riskier currencies like GBP against USD. The key lesson for UK traders: don't treat Fed cuts as a one-dimensional signal. Yes, they usually weaken the dollar, but the magnitude and direction of the move depend on expectations, relative central bank policies, and global sentiment. The Fed doesn't just change interest rates, it changes the psychology of the entire Forex market. So next time the Fed cuts, don't just blindly short the dollar. Step back, analyze the bigger picture, and remember, the spillover isn't just about rates, it's about perception, capital flows, and timing. That's the difference between gambling and trading like a warrior. Point 30, the UK pound in the crossfire. When the Federal Reserve cuts interest rates, it's not just the dollar that moves. The British pound, standing directly across from USD in the world's most traded pair, GBP USD, finds itself caught in the middle of a global tug of war. And for UK traders, this is where things get both exciting and dangerous. Here's the first reality: the pound doesn't move in isolation. Its strength or weakness is always relative to what's happening with the dollar. If the Fed cuts rates and the dollar weakens, it naturally gives the pound a lift. Suddenly, GBP day USD charts show bullish candles and traders rush in. But here's the trap. This move is only temporary if the Bank of England is on the same path. Think of it like this: Forex is a relative game, a battle of two economies, two central banks, and two policies. When the Fed cuts, yes, the dollar takes a hit. What if the Bank of England is also signaling cuts, or if UK economic data is showing weakness? In that case, the pound doesn't gain much strength because both sides of the pair are weakening at the same time. Let's take an example. Imagine the Fed cuts interest rates by 0.5% and the dollar starts falling. the pound should rise, right? But then just a week later, the Bank of England suggests it might also ease policy because UK inflation is cooling or growth is slowing. Suddenly, GBP's advantage disappears. The rally fizzles out and GBP USD may even reverse. This is why so many traders get caught out. They focus only on the Fed and forget that the pound has its own set of problems. Another factor is how global investors view the UK compared to the US. When the Fed cuts, international capital looks for alternatives. Some of that capital does flow into the UK, strengthening GBP in the short run. But investors are not blind. They look at the UK's economic fundamentals, GDP growth, inflation, Brexit-related risks, the Bank of England's policy stance. If these don't inspire confidence, the pound may fail to attract sustained inflows, even when the dollar is weakening. This creates a unique challenge for UK traders. The pound often becomes a proxy battleground for global market sentiment. When the dollar weakens, GBP/USD can spike higher. But the size and sustainability of the move depends on how solid the UK looks in comparison. If the UK economy is struggling, the pound might rise less than expected. Or worse, it might barely move at all while other currencies benefit more. We also need to consider volatility. The pound is already known as one of the more volatile major currencies. Add a Fed cut into the mix, and GBP/USD can become a roller coaster. You might see sudden surges during the London Open, sharp reversals by New York session, and fake breakouts in between. Traders who lack patience or proper risk management often get wiped out in this chaos. So how do you navigate this crossfire? The answer is awareness and preparation. Don't just trade the pound because the dollar is weak. Ask yourself, what is the Bank of England's stance? How is UK inflation trending? What's happening with UK growth and politics? The more solid the UK looks, the stronger the pound's reaction to Fed cuts will be. The weaker the UK looks, the more fragile and short-lived the pound's rallies will be. And here's the deeper truth. The pound doesn't just react to the Fed. It reacts to the relationship between the Fed and the Bank of England. The divergence or convergence of policies between these two banks is what really drives GBP/USD. If the Fed is cutting aggressively while the Bank of England is holding steady, expect the pound to rise strongly. But if both are cutting in tandem, don't expect fireworks. The moves will be muted. The UK pound is in the crossfire every time the Fed acts because traders use it as a global measuring stick. It's not just about GBP or USD individually. It's about how they compete against each other in the eyes of global investors. And for you as a trader, understanding that relative strength is the difference between trading noise and trading reality. Point 40. Liquidity shifts and London session impact. Every Forex trader knows that the London session is the heartbeat of the global market. It's where liquidity peaks, volatility surges, and most of the world's trading volume flows through. But what many traders fail to realize is just how much the US Federal Reserve's decisions shape what happens when London opens. When the Fed cuts rates, the global capital shifts that follow don't wait. They hit the London market first thing the next morning. And for UK traders, this is where the battlefield gets real. Let's start with liquidity. Liquidity simply means the amount of money flowing through the market. After a Fed cut, institutions, hedge funds, and global investors are forced to reposition their portfolios. A cut changes the risk-reward profile of the dollar, and that means billions, sometimes trillions, of dollars move out of US assets and into other markets. The very next trading day, much of that capital shows up in London because London is the global hub for Forex trading. This is why GBP/USD often becomes explosive right after a Fed move. Traders wake up in the UK and find their charts filled with large overnight candles, wild spreads, and huge gaps. This isn't random. It's global capital realigning in response to the Fed's action. If you don't understand this, you'll think the moves are noise. But if you do understand, you can position yourself to take advantage of the liquidity rush. Now, here's where it gets interesting. Liquidity is a double-edged sword. On one hand, higher liquidity means tighter spreads and better opportunities to enter and exit trades. On the other hand, it means sharper moves, more fakeouts, and brutal volatility. After a Fed cut, GBP/USD can easily move 100, 200 pips in a single session. For disciplined traders, this is an opportunity. For reckless traders, it's a death trap. Think of it like a storm. The Fed cut is the trigger, and London is where the storm makes landfall. Traders who enter blindly without a plan get swept away by the volatility. But those who understand liquidity flows know how to navigate it. They wait for the initial spikes to settle. They look for confirmation before entering. They don't chase the market. They let the liquidity do the heavy lifting for them. Another factor is timing. Many UK beginners make the mistake of trading too early, jumping into positions at the London Open before the market has digested the Fed's move. Remember, the market needs time to price in not just the cut itself, but also the tone of the Fed's guidance. This digestion process often leads to whipsaws, false breakouts, sudden reversals, traps designed to punish impatient traders. If you want to survive the London session after a Fed cut, you must respect the timing of liquidity shifts. Also, don't forget that the London session overlaps with the Asian close and later with the New York Open. This overlap creates a chain reaction of liquidity. Asia reacts to the Fed cut first, but with lower volumes. Then London picks up the momentum, magnifies it, and sets the tone for the rest of the day. By the time New York opens, the direction is often clearer, but only after London traders have fought through the chaos. For UK traders, this is both a blessing and a test. The blessing is that you're trading in the world's most active session, with the first chance to react to global capital flows. Test is that you must have the discipline to navigate the volatility. If you're greedy, if you're impulsive, the liquidity surge will chew you up and spit you out. Bottom line is this Fed cuts don't just weaken the dollar, they reallocate global capital. And those reallocations slam directly into the London session with force. If you understand how liquidity shifts, you can ride the wave. If you don't, you'll drown in it. So the next time the Fed cuts and you sit down at your trading desk in the morning, remember this, you're not just looking at random candles. You're looking at billions of dollars being reallocated across the globe, funneled into your session. Trade like a warrior, observe, prepare, strike only when the liquidity storm clears. That's how you survive the London session after a Fed cut. Point 50. Risk sentiment and safe haven flows. When the Federal Reserve cuts rates, the market doesn't just react to numbers, it reacts to sentiment. And sentiment in Forex is everything. It's not just about where interest rates stand today. It's about how traders feel about the future, whether they're confident and optimistic or fearful and defensive. That feeling drives money across borders, out of some currencies and into others, creating massive waves in the market. For UK traders, understanding this is critical because when the Fed cuts, it often sparks one of two very different reactions: optimism. Traders think lower rates will stimulate the US economy, boost growth, and fuel global risk appetite. Money flows into riskier assets, stocks, commodities, and higher yielding currencies like GBP. Fear traders worry that the Fed cut is a sign of deeper economic problems, a warning that recession is near. In this case, money flees into safe havens like the Japanese yen, the Swiss franc, or gold, and GBP can get caught in the crossfire. This tug of war between risk on and risk off sentiment is what makes trading around Fed cuts so unpredictable and so dangerous. Let's break it down. When sentiment turns risk on after a Fed cut, GBPUSD often rallies. The pound benefits because it's seen as a risk currency, not as safe or stable as the dollar or yen, but attractive when investors are feeling bold. In these moments, capital flows into the UK and Europe, and GBP pairs surge. Traders who recognize the shift early can ride strong bullish moves. But risk on doesn't always last. Sometimes the very same cut that sparks optimism one day sparks fear the next. Why? Because traders begin to question why the Fed cut. Was it because inflation is under control or because the US economy is weakening? If fear starts to dominate, the market flips into risk-off mode and GBP suddenly comes under pressure. In this environment, traders dump pounds and dollars alike and rush into havens. GBP USD can whipsaw violently, catching impatient traders on the wrong side of the trade. This is where the concept of safe haven flows comes in. Safe havens are assets that investors run to in times of fear. The Japanese yen, the Swiss franc, and gold are the big three. When panic spreads, you'll see GB JPI fall sharply, USD JPI crash, and gold spike. GBP often weakens in these moments, not because of its own fundamentals, because it's being sold to buy safer assets. For a UK trader, this means you must constantly read the sentiment. Don't just ask, what did the Fed do? Ask, how is the market interpreting it? Because it's not the cut itself that moves Forex. It's the story traders attach to it? Is it a growth story or a fear story? That single difference can flip GBP as USD from bullish to bearish in the blink of an eye. Another layer is that sentiment often shifts in waves. The immediate reaction to a Fed cut might be optimism. Stocks rally, the dollar weakens, GBP USD climbs. But over the next few days, deeper analysis sets in. Investors start asking tougher questions. If they lose confidence in the Fed's ability to stabilize the economy, risk offloads begin and GBP-based USD gives back its gains. This delayed reaction often traps traders who assumed the first move was the final move. So how do you, as a UK trader, survive and thrive in this environment? The answer is awareness and adaptability. Watch risk sentiment indicators, stock indexes, gold, and safe haven currencies. If the S&P 500 is rallying, gold is flat, and USD/JPY is climbing, you're in risk on mode. GBP/USD may ride higher. But if stocks tumble, gold spikes, and the yen strengthens, risk off is taking over. Protect yourself because GBP could suffer. In Forex, risk sentiment is like the weather. It changes quickly, and if you don't prepare, you'll get caught in the storm. When the Fed cuts, the clouds of fear or optimism spread across the entire globe. UK traders can't stop the storm, but they can read it, adapt to it, and trade with it. That's the difference between those who gamble and those who survive. Remember, it's not the Fed cut itself that destroys accounts. It's failing to read the sentiment that follows. Point 6C. Strategy for UK traders: understanding how the Fed impacts the pound is one thing, but knowing how to trade it is another. For UK traders, Fed cuts create both incredible opportunities and dangerous traps. The difference between blowing your account and building it lies in your strategy. The first rule is don't chase the first move. When the Fed announces a cut, the dollar often reacts violently. GBP/USD may spike up or down within seconds. Many beginners think this is the moment to jump in, but that's the biggest trap. The first move is often driven by algorithms, big institutions, and emotional retail traders. It's noise. Real direction usually appears only after the market digests the Fed's words, tone, and future guidance. So instead of chasing the first candle, step back, observe, and wait. Patience is your weapon here. Second, always pay attention to the Bank of England. The Fed doesn't operate in a vacuum, and neither does the pound. Ask yourself, is the Bowie hawkish or dovish at the same time? If the Fed is cutting aggressively, but the Bowie is steady or tightening, GBP/USD has room to climb. But if both are signaling cuts, the pound's advantage shrinks. Your job is not just to trade the Fed, it's to trade the divergence between central banks. That's where the edge lies. Third, understand that volatility is not always opportunity. After a Fed cut, liquidity floods the London session, creating wild swings. Undisciplined traders see this as easy money and start over-leveraging. But volatility without control is destruction. The market may whip 100 pips up, then crash 150 pips down. Without stop loss discipline, you'll be taken out in minutes. The real edge comes from using volatility wisely, entering only when your setup aligns with the broader narrative. Fourth, watch the bigger sentiment signals. Don't just stare at GBP/USD. Look at the S&P 500, gold, and the yen. If stocks are rallying, risk appetite is strong and GBP may benefit. If gold and yen are spiking, fear is rising and GBP may fall with other risk assets. Your strategy should always include cross-checking risk sentiment before making a move. Fifth, scale your risk. During normal weeks, risking 1-2% per trade may be fine. During Fed weeks, cut it down. The market is more volatile than usual and the chance of whipsaws is higher. By reducing your risk, you give yourself room to survive the chaos and still capitalize on the bigger, cleaner moves that follow. Finally, think long-term. The Fed's impact doesn't vanish in a day. A cut sets the tone for weeks, sometimes months. Don't measure your success by catching the first move. Measure it by aligning yourself with the trend that follows. If the Fed signals a cycle of cuts, the dollar may weaken steadily over time. This is where patient traders build their accounts, not by gambling on headlines, but by positioning themselves with the longer trend. To sum it up, don't chase the initial reaction. Compare the Fed with the Bank of England. Respect volatility. Don't confuse it with opportunity. Track global sentiment through stocks, gold, and safe havens. Scale risk during high impact weeks. Focus on the long-term trend, not the short-term noise. This is how you trade like a warrior, not a gambler. The Forex market doesn't reward speed, it rewards patience, discipline, and awareness. When the Fed cuts, the weak traders rush in and get crushed. The strong traders wait, observe, adapt, and then strike with precision. For UK traders, the Fed isn't just an American institution. It's a storm that reshapes your battlefield. Surviving that storm requires strategy. And the traders who master it don't just avoid destruction. They use it to build lasting success.